Hey everyone, today we're going to answer the big question. Can you afford to retire? You know, if you do a quick online search for the term, can I retire with, and then just leave it blank, you'll see thousands of search results for, can I retire with 500,000? Can I retire with a million? Can I retire with 2 million? And the list just goes on and on and on. Well, today I'm going to tell you how to do this calculation for yourself so you don't have to rely on the sometimes less than accurate information you often find online. Just know what we're talking about today isn't precise planning. This is going to be napkin math. But you've all heard me say before that this is your retirement and no one is going to feel the pain of retirement mistakes like you will. So I think it's important for you to understand how to do these rough calculations for yourself. So today, I'm going to show you how to estimate your retirement income and then run it through a tax calculator to get the net amount of income you can expect. So let's dive in. But first, since we are talking about retirement planning, before you leave, you really got to get a copy of my retirement planning cheat sheet. I talk about my Social Security cheat sheet fairly often, but this is the retirement planning version of that. This has the retirement plan limits, the federal tax brackets, the modified adjusted gross income limitations for the various programs, and a lot more listed here as well. If you've enjoyed my Social Security cheat sheet, I know you'll like this one, and there's going to be a link down below where you can download it for free. And as long as you stay on my email list, I update that every year, and I'll keep sending it to you. So let's get back to the question, can you afford to retire? Now, before I get into all the details, let me give you the easy, succinct answer. Yes, you can afford to retire as long as your retirement income goals line up with your savings. Now, I know that may sound overly simplistic, but that's really what it comes down to. So the first thing you need to know before moving too far down the road of retirement planning is to define your income goals. The question I always like to ask when I'm helping someone with a plan is, how much do you need deposited into your bank account every month to pay your bills and live the lifestyle you want? Now, I find a mixed bag when I ask this question. Some people have no idea how much they need, and then others have a spreadsheet with the exact amounts. And then others think they know, but they're not real sure. But this is something that you need to get defined before you can get specific about your retirement plan. The amount you need to spend is the foundation your retirement plan is built around. Now, there are some rules of thumb that some suggest you should use to arrive at this number, like 80% of your pre-retirement income, but I have found those rules are broad and maybe overly broad generalizations of how much you'll need. Until you put pen to paper, you won't know. Calculating this probably needs a video all of its own, but it's really important to go through this exercise of figuring this out. Doing it after you retire is just too late. So once you figured out your retirement income need, it's time to answer the question, have you saved enough to retire? The first thing you'll need to do is add up all of your savings that you'll use to contribute to your retirement income. This could be your IRA, 401k, Roth, non-retirement accounts, and a host of other type of accounts that you could have. If you're invested primarily in stocks, you should be able to take 5% of that amount per year if you're willing to adjust your distribution based on market volatility. So every year, your withdrawal is 5% of the portfolio value as measured on a certain date. Most people will use the last day of the year to measure that. At the close of the calendar year, the value of their portfolio dictates what their withdrawal will be for the next year. So for example, if you retire with $1 million, you could take out $50,000. If your portfolio is increased to $1.1 million at the end of the year, the following year you could take out 5% of that, or $55,000. If your value declines to $800,000 at the end of the year, your withdrawal would need to be decreased to $40,000. Now that's a rough napkin math way of looking at it, but if the market continues to be up 3 out of every 4 years, you shouldn't have too many years when you need to take a cut. Now, if you don't like the idea of occasionally reducing your income based on market volatility and you want some greater income stability, you may need to look at using a 4% distribution rate. This is probably the most well-known rule for retirement spending, and it's really easy to understand too. It says you can withdraw 4% of your retirement savings in the first year of retirement. For years after the first year, you can adjust it upward to account for inflation. Now, if you stick to this formula, there's almost no chance of running out of money. So for example, if you have $1 million saved, you'd be able to withdraw $40,000 the first year and increase that amount every year for inflation and never worry about having to decrease that annual distribution. Now, that 4% approach is very simple to understand, but I also think it has a few issues that I've talked about before on this channel. I think it's too rigid and too conservative. The goal of saving for retirement is to build a pool of deferred income that you can turn on in retirement and not build a pool of money to leave to your kids. It's fine if you want to leave some money for your heirs. We see that fairly often when we're building plans, but I always recommend digging deep and defining what your ideal retirement looks like and how much income you need to fund it. Take care of that first, and then if there's anything left for the kids or other heirs, fantastic. As one of my YouTube commenters said, don't fly coach just so your kids can fly first class. So my preference is to use the 5% rule and be dynamic in the annual distributions. So let's use that and walk through a full example here. Let's assume again that you have $1 million saved in your 401k. Using that 5% distribution model, you'd have $50,000 per year or $4,166 per month. If you've been able to save that amount, you likely have good earnings and your Social Security benefit would be somewhere north of $2,500 per month. But for our illustration, let's just assume that it's exactly $2,500 per month. And then if you're married, and let's just assume in this case that your spouse stayed home and managed things while you went to a traditional job, so they would get about 1/2 of your benefit. So that's another $1,250 per month. All of those are at full retirement age, of course. So in this case, you'd have $4,166 from your retirement savings, $2,500 from your Social Security benefit, and another $1,250 from your spouse's Social Security benefit. Now that brings this total to $7,916 per month. Now that's gross. You still have to pay taxes on that. And to calculate the federal taxes, there's a number of tax calculators you can use, but the one I like best is the one that TaxAct has on their website. Let me walk you through an example of how theirs works, and we'll run these numbers through there. And I'll also link this up below, but you can just go to taxact.com, then go to Tax Tools, and then to Tax Calculator. And this is where you'd start putting in your information. In our example, we'll just assume this is for someone who is 66 years old in 2022. So we'll use a date of birth of February 1, 1956, and then we'll answer the questions. Did you use TaxAct to complete last year's taxes? No. Are you single or married? In this case, we're assuming this is for a married couple, but select that box based on your scenario. And then if you are married, there's going to be an additional box that pops up and asks if you're married filing jointly. If you don't select that, it will assume you're married filing separately and give you a much lower standard deduction, which will increase your taxes. And then, can you be claimed as a dependent? In this case, it's no. Then do you have any dependents? Again, in this case, it's no. And then hit next, and this is where you put in your income. And you'll need to go down and click the down arrow under View All Income. In our example, we're keeping it really simple and just assuming this couple is taking out $50,000 from their retirement account, so that would go in the taxable IRA and pensions box, and then total Social Security benefits of $45,000. When you hit next, it clearly shows you what your tax bill would be based on that income. So if you have $50,000 in IRA distributions and $45,000 in Social Security benefits, you'd pay about $6,000 in federal taxes, which means that your net would be about $89,000 or $7,400 per month. Now, if you live in a state that charges state income tax, I put a link to a calculator in the description that'll give you both federal and state tax numbers. It's not quite as easy to use, but finding one that does the state calculation is not that easy either. So that's a really good one that I like using down there. One quick disclosure here. I would be comfortable relying on a calculator like this for the rough numbers, but if you want to get specific and make sure of what the tax bill would be, it would be a smart idea to go pay for an hour or two of a tax advisor's time because, again, this is just the rough math. So walking through these steps I just laid out will give you a rough idea of what to expect, but it still leaves a lot of questions unanswered. For example, what about the timing of Social Security in conjunction with the distributions from your IRA? For example, if you retire at 62, should you go ahead and file for Social Security? In so doing, you'll reduce the strain from taking large distributions in the first few years, but needless to say, waiting will increase your benefit, which would eventually reduce the strain of the distributions later. Which one would result in a better outcome? What about if you have non-retirement accounts or Roth IRAs? When do you tap those for income? And let me tell you, those decisions can make a big difference in the amount of taxes you pay, and it will absolutely affect how long your money lasts. And then the other thing that's not addressed is variable spending. I rarely find that someone retires and takes a perfect stream of income that's adjusted for inflation every year for the rest of their life. What happens instead is that a retiree will often have a variable spending goal that will start off heavier. They may want to travel, pay off their second home, or do something else they've been putting off while they were working. And we also see that as someone ages, their desire to spend money goes down. And that's why in our plans, we generally build in a 20% reduction spending at age 80. After walking this road with retirees from the point of retirement all the way to their death, I can tell you that that type of spending is more realistic. And all of these variables needs to be part of your retirement plan. I know it is with our retirement roadmap plan. It considers each person's needs and objectives, and it builds a customized spending plan that's unique to them with a focus on tax efficiency. If you think this is a conversation worth having and you want your own plan that will make sure your money will last, be tax efficient, and tailored to your spending goals, you need to get in touch with me and my team. We'd love to help you with a plan that simplifies these decisions and gives you the confidence to move into this next phase of your life. If you want to get your own plan, here's what you need to know. Our strategy works best for those who have at least $500,000 in retirement assets because our approach to planning often requires these savings balances to maintain the flexible distribution sequences. If you want more information about engaging us, I've linked a page down below where you can read more, and if you like what you see, there's a link on that page where you can schedule a consultation with me and my team. This will just be a phone call where we find out more about your needs. I actually conduct a fair number of these calls myself, and based on that discussion, we may or may not recommend one of our plans because not everyone needs our services, and we do only want to use our time and energy on the cases where we can add value. So if you look in the description, you'll see that link, and we'll pin it in the first comment as well. Thank you for watching.